Hello, everybody. Happy Saturday. Welcome to another Self-Directed IRA Saturday. Thank you for joining us. Sorry we're a little bit late, a couple minutes, but thank you for being here. We have a great speaker today, Kira Golden. Can't wait to see her presentation. We're really excited to have her here today. But before we get started, we just want to do a couple of, run a couple housekeeping things through you guys. Just wanted to remind you of our socials. Of course, our self-directed IRA Saturdays every Saturday, just like now, just like today and right now at noon. We have a webinar, and then we also have our socials every Tuesday at 6 p.m. We start. In Houston is the first Tuesday of every month. In Austin is second Tuesday, and then in Dallas is on the third Tuesday of every month. So join us there for some education and then some networking opportunities there. And then also, if you're looking to raise capital to deal pitch, this is something that we also bring on there every time we meet, so that our clients have an opportunity to meet with people who are looking to raise capital, for example. So great opportunity there to network as well. We also have our National Networking Happy Hour. It happens every fourth Wednesday at 6:30 of every month. This is more for people who cannot join us live in person. We have this every Wednesday, every fourth Wednesday of every month. So it's a great opportunity also to network, and it's deal pitching basically. We started a new LinkedIn Live class we're really excited about. The next one is on June 8th, so at 1 p.m. So make sure you join us there. And if you miss any of our classes, of our webinars, make sure to go to our YouTube channel, because we post everything on there. So yes. This is the rewards for deposit promotion that we have going on today. If you open an account and move in from 100, this is for new and existing clients, but if you move in 100,000 to 300, you get 125 credit towards your account. And then from 300 up, 250, and from 500 up, from 600 up, you get $500 credited towards your account. So make sure you make use of this. Finally, we have a really great multifamily summit event happening in Dallas. Make sure you get at me for additional discount coupon. But this is going to be a really great one. We're really excited about it. August 12th, again in Dallas. It's going to be a full day. So yeah, make sure to check it out. It's going to be amazing. So without further ado, I'd like to bring Kira Golden on and get started. Kira, thank you so much for being here today. I'm really excited about your presentation. So just whenever you're ready, go ahead and take it away.
Okay, great. Well, thank you, Andrea, for having me. Really appreciate it. And Victor, thank you for making the slide upload and everything so seamless. Appreciate you guys at Quest. I do a lot of speaking engagements, and you guys made it very easy. So definitely doing things well. So excited to be part of the team and sharing some education and learning with some of our investment partners. So I am really excited to be presenting to you guys today. I was lucky enough to attend one of the Quest events mentioned earlier in Houston a couple months ago and got to meet this fabulous team. We've worked with many IRA custodians, and Quest's dedication to its account holders and partners is really something to behold. I'm very impressed with the team and happy to be here. I hope that today we can add a ton of value. Also make myself available offline if you guys have additional questions or whatnot. I have been in the real estate space for 20 years now, which is crazy to say, but I did start right out of high school, so I can keep going with that one. I used to get people saying like, "Oh, you're way too young to have been doing this so long." I don't hear that so much anymore, but do have 2 decades of experience and been through a couple of market cycles. And as many of you are probably keenly aware, there's a lot of cash sitting on the sidelines. There's a lot of fear right now. There's a lot of uncertainty. And I have made my career in how I've navigated periods of fear and uncertainty And so I'm excited to share some ideas and some philosophies behind what I do, why I do it the way I do, and some practical tips and tools to support people. As we go through the presentation, you guys will see there's aspects in which I'm sharing information with other active operators, deal sponsors, or deals that you're running and structuring on your own, because I understand a number of you are still out, creating your own deals and offerings, or doing your own deals as a sole investor, and other people are passive LPs. And so I tried to address both of those, and feel free as we pause after each section for Q&A to ask questions about either side. I'm happy to share what I've learned as a sponsor, but I also work and invest as an LP too. And so I have some tips and thoughts there as well. I've been actively syndicating deals since 2013. And have very intentionally taken a break over the last couple of years. And we'll talk a little bit about why and what we're doing there. And just a little bit about, I'm going to share a slide, just a little bit about me and my motivation. Those are my kiddos right there. So I'm a single mom of 2 kids. You can see in the top left 2 pictures there, there's my son, Calais, who's now 8. In the middle picture, he was 6 weeks old, and we were in Dayton, Ohio, on a construction project. And you could see he returned to that project at about 18 months old. And then also a project in Glendale, Arizona. So my boys have grown up, literally grown up in the real estate space, looking at properties, looking at deals. And it's that flexibility and the ability to have this be a legacy asset and a family investment that really enticed me to real estate in the first place. Over the years, so just a little bit of background. I owned a private mortgage bank in Arizona from 2012 to 2019. We did a lot of hard money lending at that point. I own and operate a number of Airbnbs in the United States and internationally. I do commercial, residential, commercial, industrial. Have done thousands of residential fix and flips in Arizona, Puerto Rico, Chicago, Washington State, in the United States and abroad. So I have leveraged opportunities internationally starting in 2006, came back to the United States, invested again starting in 2009, went international again in 2013, and now I'm gearing back up to invest domestically. So looking for opportunities. I believe there's always opportunities to put capital to work, but it's important to have both a global perspective, a broad asset class perspective, and to structure things properly. So I'm sorry, I'm going through some notes here, which is my first time. Usually I talk from the cuff, so bear with me if I'm a little robotic as I read notes. I think enough people have probably gotten up in front of you guys and talked about how great real estate is. So I'm not going to do that. I am actually going to focus on some of the hard-hitting truths, some of the paralyzed. I know many people right now are paralyzed with fear and not taking action. And as my spirit animal, Warren Buffett, says, when others are fearful, be greedy. And when others are greedy, be fearful. And you guys will see a lot of Warren Buffett quotes through this. He is an unofficial mentor of mine, and somebody who philosophically I'm very much aligned with. And to that point, one of the other things he talks about is real estate as a long-term game. You don't make money overnight, but you can build wealth over time. And as we look at some specific strategies to structure deals, to be less interest rate and market sensitive, one of the key underpinning philosophies there is that I'm a long-term buy and hold investor. If somebody is looking to just churn capital as quickly as possible, we will not be philosophically aligned. So you can watch a different webinar. But if you're really looking at building either for yourself, or I really take a multi-generational lens when I look at putting what I call chips on the table when I buy real estate. And I believe that is probably the fundamental core perspective that really allows us to navigate shifts in the market, combined with some other structuring and underwriting perspectives. Again, Buffett real estate is a long-term asset. It is a terrible thing to trade in and out of. And we'll look specifically at that and why why we buy things with a very long-term perspective. And I think that that's going to be somewhat unique in the industry. A lot of syndicators in particular get in and they have a 3 or 5 year horizon. Investors are sort of conditioned to want to get in and get their money and get out and go do another deal. But we're going to look at why that might not make sense. And I will say, as a sponsor, oftentimes deals that we purchase are 10 years out before we start to see any upside or participate in the promote. So we own and operate that asset alongside our LPs for 10 years before we see any upside. And again, that's a long-term perspective that not everyone can afford to take, but I believe that it is a fundamental underpinning of how you navigate various market downturns. And a last one here, investing is simple but not easy. So we're going to talk about some very simple structural things that you can do. But I think the not easy part really gets to the emotions around it. I have found that one of the hardest things as an investor and maybe as a human being is to wait, to be patient, to do nothing. Action often feels like progress, and they are not necessarily the same thing. And calming yourself down, stilling your heart, being patient, and really going, what has fundamentally changed that is changing my macro strategy? And if the answer is nothing, insulating yourself from the noise and staying the course is not easy, but it is what makes a great investor from somebody who maybe gets emotional and might lock in some losses when it doesn't make sense. So in order to share with you about what I do well, I think I need to articulate clearly some of the mistakes I've made and mistakes I've seen made. While real estate is a very powerful tool, like any other tool, if you use it incorrectly, it can hurt you. Real estate is not something where you always make money no matter what. I've seen a lot of people lose a lot of money in real estate. I've had 2 deals in the last 20 years that I've sold at a loss, the biggest one at a 30% loss. That was not fun. And I've occasionally had projects where I've bought a portfolio of deals from a bank, knowing that 2 or 3 of the properties in the portfolio were not going to pencil out, but the upside on the other deals was so good, it still made sense. There was no way the bank was going to sell me the portfolio without taking the ones that were going to be at a loss. And so we'll talk a little bit about that too, and using a comprehensive perspective. Sometimes a particular deal might not do so well, but it opens doors or it gets you into a new marketplace, builds relationships that eventually lead to some very high profit deals. And so having a comprehensive and long-term approach is really critical. So with that, let's jump into 3 of what I consider to be the most common mistakes. The first one is trust, and specifically blind trust, putting blind faith in other people. And and then the second one is greed, letting the idea that you can make so much money cause you to make some imprudent decisions or join a partnership that really isn't great. And we've lost new investors at times to pro formas from other sponsors that looked a heck of a lot better than ours, who come back 3 or 5 years later because we executed on our pro forma and the other one wasn't able to. So I think it's just as much a responsibility of an LP or a co-sponsor to dive into and look at the assumptions in the market and make sure that they're realistic, and that this is a slow and steady game. It is, while you do want to go after grand slams, the most important thing is making sure that our fundamental assumptions are solid and that we've stress tested changes that are going to happen in the market. Because while we can't predict when, the macro trends are fairly anticipatable, and we'll dive into that. And then pride. Pride tends to lead both sponsors and LPs to not only make sometimes not the best decisions, but then stay in, hide, or cover up mistakes instead of really humbly sharing with our partners, hey, here's what we've come up against, here's what's happening. And we'll talk a little bit about both some structural things that'll help avoid that driving somebody down, but also some spiritual things that will help make sure that we have the right kind of heart as we approach doing this. Trust, of course, is important. But blind trust is specifically what I'm concerned about. And I have definitely put blind trust in some sponsors. So as I've grown my investing, I used to be an active operator. I used to do everything, all my own property management, every aspect, underwriting the deals, buying the deals, managing the deals, everything. And in order to grow, I had to start handing off pieces to other people. And oftentimes, I don't know if any of you have experienced this, but I don't realize I need to hand something off to someone else or work with someone else until I am so overwhelmed and exhausted that I just want to, what we call abdicate rather than delegate. So it's just like, here, you handle this. So exhaustion, fear, and which can lead to being, confused about what to do or wanting to believe that, hey, someone else is going to know better than I know, and so I'm just going to hand this off to them, or a lack of systems and accountability for proper delegation. So we're going to draw the distinction between blind trust, which is just, hey, you handle that, and I've done that before, and honestly, most of the times when I've what we call been burned, it's because I've just put blind trust in somebody. And as a sponsor, it's just as scary for me to hear someone say, I'm investing with you because I trust you, as it is when I do it as an LP, because I do know that I need and I want trust, but I want people to trust my character. I want people to trust that I will always be honest and transparent. I want people to trust that I am going to always give everything my best. But sometimes blind trust can look like I'm giving you my money and I just trust this to work out. And we need to be really honest with ourselves that investing comes with risk and it doesn't always work out. And there can be a lot of changes to a business plan or model. And so having trust in the person is great, but also making sure that we have a knowledge of an understanding of what we're investing in. So the next piece of this is greed, right? We hear often greed is good, but this looks at the market cycles that we've been through that have been driven a lot by greed. I have to look forward to read it, but like in the early 2000s, before the 2001, 2002 market crash, people were investing very aggressively. Market came down, and then people went from the emotion of greed to fear. And then 2008 hit, and we thought, people aren't going to be greedy anymore. We've learned our lesson. Adjustable rate mortgages, credit swaps, derivatives, these words that you might remember from 2008, 2009. But man, did people forget that. And in 2012, 2013, once again, we see people thinking, oh, the market's only going to go up and only good things are going to happen and everything's going to be fine. And greed or blind trust really driving people to invest in imprudent deals once again. And, real estate does always throw us curveballs. Just as a reminder, interest rates, for example, there were a lot of people out there who were getting 2-3% variable interest rates and somehow thinking that was going to last forever. Well, we don't know when, but we have to know that when we are at 100-year low on interest rates, that there's really nowhere for them to go but up. And so I think sponsors who were really paying attention took very aggressive moves to lock in as long-term and fixed interest rate debt as possible. And so almost all of our portfolio over the last decade has at minimum 10-year, if not 20 or 30-year fixed rate mortgages, because interest rates were going to have to go up. And anybody who was getting into adjustable rates, other than in very specific situations where you were maybe in a deal for a short period, maybe you were in like a construction system and then you were going to move to a fixed rate loan. But anywhere where you could avoid was a good idea. And this chart just shows, and I have to lean in to be able to speak to it, but this comes from the Federal Reserve Bank of St. Louis. And these are the foreclosures, the percentages of foreclosures over the last 2 cycles. Adjustable rate mortgages, the percentage of foreclosures was 76%. Fixed rate mortgages was 10%. So, the nice thing, again, going back to this fundamental principle of real estate being long-term and buy and hold, on our properties that are fixed rate mortgages, I'm not going to lie. Yes, we are seeing higher bad debt. We are seeing more concessions right now. We are seeing more write-offs, higher vacancy. But because we have the fixed rate debt, two things aren't happening. Number one, we're not having a loan come due that we have to refinance at a terrible time, and we're also not having any sort of unexpected changes in our spread between our net income and our expenses. Because long term with real estate on a fixed rate, if your mortgage is staying here and rents are going like this, even if rents go this way, that spread between your fixed mortgage only serves to better your deals over time. So, being thoughtful about long-term, I will even take a long-term higher interest rate loan up front. And this gets to the whole greed factor. People want to squeeze as much cash out of their deal right away as possible. Sponsors want to do it because LPs think that, that everything's about buying a coupon and buying a yield. But really those that are prudent and put themselves in a good long-term position are going to eclipse those that were very aggressive in the short term. Similarly, Buffett had that quote about trading assets, and I want to talk about the impact of taxes and transaction costs. So one of the reasons that I, as a sponsor, am content to wait 10 years before I start to see any cash flow from the deals that I sponsor with my LP partners is because every time we do a transaction, you've got approximately 10% of taxes and another 5% or so of transaction costs. So your capital base is eroding at about 15%. So when you think about it this way, let's say you're getting a 6% dividend distribution from the cash flow on an investment, and market gets a little wonky, and so now we need to cut that distribution down from 6 to 4. For some people, that'll feel like, oh my gosh, we're not doing as well. There's a problem. We should sell this asset. Well, if you're going to take a 15% hit to sell the asset, 15% over, let's say, 5 years is 3% a year. So you could cut your distribution 3% for 5 years and still come out ahead by not selling that property. Now, it won't feel as tangible, liquid cash in your hand, in your pocket, but that's why investing is simple, but not easy. It takes discipline and focus and commitment to stay the course during these markets. Pride really hurts performance too. Some of the mistakes that I've seen made, or that I've made myself. This one I'm super guilty of, thinking that I can create all the value and I can do it all. Early in my career, I really had a lack of systems and processes. You have to slow down to build systems, and in your 20s, slowing down isn't necessarily like attractive at all. But you do learn that you get humbled if you've been in the business a while, and that's why I think working with people who've done this for a long time is good. And we do everything systematically, programmatically. And I have arguments sometimes with my LPs who want to change course. And it's always like, why? Why are we changing course? What in the system or process has changed? If there's a reason to do it, we'll do it. I'm not rigid, but I am systematic. Oftentimes, it's also a lack of understanding. We develop in our own heads our expectations. I've seen this both on the sponsor and LP side. As a sponsor, deals are evolving, and I get really present to what the current business plan is. And if we're executing the current plan, I feel like, hey, we're being successful. And other times on the LP side, an investor will get used to a certain distribution. Maybe we exceeded expectations for a few years and we were distributing 8 or 10 or 12%. And now we have to cut back. Well, that doesn't feel very good. But if we remember, we go back to our pro forma, or we go back to our business plan, that maybe our plan was only to distribute 6 and we've been distributing 8 or 10. that the fact that we have to go back to 6 isn't necessarily a problem, right? But we can get stuck in our own head and our own expectations. So always going back to the agreements, always being sort of thoughtful and humble about, hey, you know, let's go take a look at what's going on here, and having those open channels of communication. That's what's going to get partnerships, and that's really what these are, sponsors and LPs, to get those partnerships through difficult changes in the market. And then, of course, the lack of humility, trying to cover up failure. You know, the best thing is admit it, learn and grow from it. And this is just like any other relationship. When I have great LPs, they foster a safe space for me to come to them and say, this isn't working, we need to fix it. And I'll give you an example. On a project, we just had a theft. We had all of our meter bases stolen. It's going to take a year to get those back. And we immediately emailed our LPs and said, here's what's happening. Does anyone have any connections? By the way, anyone on this webinar, if you have any connections to get meter bases, we need to get meter bases, and we can't wait a year. And I have seen people in our industry, and I've seen people in other industries try to cover it up. And it's always this thinking of like, if I could solve the problem, you know, give me 2 weeks, give me a month to solve it. I don't want to have to tell people I made a mistake and I can fix it. And then I don't have to tell them no harm, no foul. That is such dangerous thinking. There's nothing better than saying, hey, I made a mistake, and 2 weeks later saying, hey, I fixed it. And obviously the meters, that's not even a mistake, but hey, something bad happened and then I fixed it. You know, communication and that humility to communicate is key. And that was really, personally, that was a challenging thing. I had a project that was over budget, over time. Everything was going wrong. Everything that could go wrong was going wrong. We got hit by a tornado. We went through COVID. We had a fire like a week after we bought the property. I mean, it was just like everything. And, you know, we had to renegotiate with some of our lenders an extension. They weren't happy about it, understandably. And we had a refinance investor coming in who was going to buy out that loan. And they wired on Friday, and we were supposed to close on Monday. And over the weekend, they had something happen on another project, and they needed that money back. And they emailed the title company and said, hey, sorry, we can't make the loan. And we didn't really have any recourse to hold them to that. We hadn't received a firm commitment yet. And so I had told all the investors on, you know, Friday that this was happening, and on Monday it wasn't going to happen. And there was a moment where I had to deal with my own integrity and say, you know, if I buy myself a couple of days, maybe I can find another investor. Nobody has to know anything. Like, I went through all that thought process. And I think anyone who isn't honest with you and acts like they never are challenged, or never have any doubts, or never have any impulse to hide or have shame, they're liars. You want to find people who are willing to look at that and then make the right choice. And so, you know, I went through a weekend where I was like, what am I going to do here? What do I do? And I had to have faith in my LPs, and I had to reach out to them and say, here's what's happened. And every time I do that, every time I have faith in my investment partners, all they do is prove to me that their faith is well put. And I hope that the same happens in reverse, that when they have faith in me, I prove to them that that faith is well put. And we build our trust, and we build our ability to grow together. But that takes a lot of humility and vulnerability. So I bet many of you were thinking, when we talk about investing, you probably didn't expect to be talking about humility, vulnerability. But I really believe that these things are the underpinning of what creates great execution. It's both character and knowledge and excellence and execution. And so you need both. But most of the times when there's been a failure, it's not because of execution, because, to be honest, execution will fail. That is a given. There are going to be things either in the circumstances or the situation that will cause us to not execute plans as expected. And that's why character is such a core underpinning and foundational piece. So how do we solve for this? How do we address, the blind trust, greed, and pride? And to me, I think the answer for the first one is discernment. For pride, for greed, it's really about prudence on the front end, and then generosity once you've already entered that partnership or relationship. And then, of course, as I've talked about with pride, it's the antithesis of that with humility. And how do we structure things that create more discernment generosity, and humility. So this is kind of what I just said: discernment to blind trust, generosity to greed, and humility to cover pride. So before we jump into that, I'm going to pause actually and see if there's any questions on the problems on the front end before I jump into some of the solutions and the ways to address them. Oh, thank you. Someone did ask, what is an LP? Oh my goodness, I'm sorry. I try not to use acronyms. LP stands for limited partner. So when there are deals that it's not just one person doing their own deal, the GP, the general partner or the sponsor, is running the project. We're the ones doing the heavy lift, us and our team. And the LP is the limited partner. They're limited in both their liability and their responsibilities. But they are still partners, and there's a lot of times where it's important to be in great communication. It is a relationship and a partnership. Any questions on that section before I move on? And we will do more questions at the end. Okay, great. So discernment. So whenever I think about trust, I use this acronym for trust. And it's really more about, rather than having blind trust, it's about how do I build trust intentionally with someone? And there's a bunch of questions that are good to ask on the front end to build trust. And then, like any relationship, watching how they actually execute on those things. So number one is track record. Somebody should be able to tell you about their track record. And most importantly, tell you about, this kind of gets to the second one, regrets, their failures, their losses, both where there were actual losses and failures, because anyone who's been in the business any length of time has at least one they can tell you about. And well, not any length of time, but let's say 5 years or more. And more importantly, where things haven't gone according to plan and how that's been handled, how that's been addressed. Regrets are really, what I've done wrong. And again, more importantly, what are the lessons learned? Underwriting assumptions. So, dive in, look at the underwriting assumptions. Don't invest in something that you don't understand. You want to know, what are they assuming inflation is going to be? What are they assuming? Because we have seen double-digit increases on utilities, property taxes, labor, materials, and extensions of timelines to get these things. And so in their underwriting, not only what are their assumptions, but do they stress test their deals? For example, on the off occasion when we use an adjustable rate mortgage, we had an adjustable rate mortgage on a property in Ohio that was low threes when we first got into it. That's now at almost 11%. And we stress test that before we went into it with rates going up to 10. And thank God we did. 11 is hurting us. I'm not going to lie. Going from 3 to 11 is brutal. But we're in the process of refinancing that into a fixed rate 7. And the good news is 7 isn't going to hurt us, because I anticipated that we could be as high as 6, 7, 8% interest when we refinanced out of our adjustable mortgage. And the other property that's part of that same portfolio is locked in at a fixed 2.99. So the combined rate between 7 on 5 million and 3 on 5 million still has us at a very good long-term fixed interest rate. So understanding those assumptions and the stress testing. Strategy, I've talked about this a few times. Long-term, buy and hold, low transaction. That's our strategy. We are building for intergenerational wealth. We are building for cash flow, and we are building for stability. Other people are more like, my strategy is I want to get in, I want to flip, I want to build capital. And if you're an investor who wants to move fast and wants to turn product, you're not going to do well with a sponsor like me. If you're an investor who wants to set it, forget it, and just let it build, you're going to get agitated by all the tax forms and reporting and everything that happens in transactional driven strategies. So know the strategy, know that you're aligned in the strategy. And then the last one is tough questions. If someone gets defensive when you ask tough questions or dismissive, that is a huge sign that they aren't worthy of your trust. So when we talk, trust isn't a terrible thing, but when we talk about trust, we want to think about track record, regrets, underwriting assumptions, strategy, and tough questions. Now let's talk about the antithesis to greed, which is prudence and generosity. So For example, I'm going to get it. Well, first, let me speak about it, and then I'll get into some specifics, which I wrote on the board for you guys, of specific techniques we use to make sure that there is room to be prudent and to be generous with one another. Oh, sorry, on the last one, I forgot my specific steps. So I can circulate these and share them with you guys, but make sure all LPs are clear on what the levels of responsibilities are and what the outcomes are. Stress test all your deals. Have multiple third parties sign off on your pro formas. So we have our property manager, we have our lender, we have our asset manager, all sign off on the pro forma that we use before we execute on a deal. And find legal problems that you really are the best fit on to solve as a buyer. And as an LP, understand your position in the capital stack. Don't just assume because the project's returning a 20% cash on cash return that you're going to get 20%. You want to understand the waterfall and how that's all working. Okay, that's under trust. Prudence and generosity. Start slowly. Make minimum investments with initial syndicators or sponsors until you've seen some of their track record executed. And at the same time, make sure you understand the assumptions. Remember that as an LP, it's your responsibility to understand what you're investing in and that it has a high probability of success. Anyone can make a pro forma look good. You want to understand why and what the assumptions are and what they're going to do if things don't go the way those assumptions were created. I spoke already about interest rates, so I'm not going to spend a lot of time on that. But then the other thing is invest in a few deals with a sponsor. I always tell people if you invest in 5 deals with me, one is going to have a lot of issues. One is going to really knock it out of the park way better than we expected. And 3 are going to more or less go along the line of the pro forma. And I have had investors who only invested in 1 deal. And that 1 deal was the bad one, or that 1 deal was the really good one. And then that's their experience of us. They either have an overly positive experience or an overly negative one. So diversifying across a few offerings, even with the same sponsor, is a great way to understand how they work. You can achieve an average return of 8% by getting, 0, 0, 0 for 3 years. 0, 0, 0, 0 for 4 years and 48% in the last year. That's still an average of 8%. Or you can get an average of 8% by getting, 2 years with 0 and 2 years with 40%, and then it averages out to 8, or you can get 8 year over year over year. And so when you look quickly at a pref return of an 8%, understanding when that cash flow is going to flow is going to be really important. So being prudent about not just what the averages are, but what the experience of the deal is. And then once you're in that relationship, being generous with one another, not just with money, but really just about feedback, communication, time, understanding, and working together to make sure that you end up with the best possible deal. Structure tips on prudence and generosity. We use supplementals. So especially in a rising rate market, if you lock in 2.99, a lot of sponsors don't want to do that because they plan to refi after they've finished a value add or something in 2 or 3 years. Well, we still do a fixed rate Freddie loan, and we use something called supplementals. So we might have, like I said, a 2.9% interest rate on the first 5 million. And then the second 5 million, we may be at a higher rate. We might be at 5, 6, 7, 8, 9%, but we get a better blended rate by using supplementals. We always establish working lines of credit so that we can ride out shifts in the market. And we work towards and establish 6 months to 1 year of operating reserves, and we distribute our distribution 6 months in arrears. So we have the 6 months of distributions before we start distributing it out. Promising lower distributions and being willing to cut them, even if it's upsetting. And this again gets back to generosity. When a sponsor needs to make some of those tough decisions, it's great to know that the limited partners understand that is being prudent and not necessarily an indication of a deal failing, but that when my LPs say, I'm really glad you're doing this on the front end, and we're going to cut our monthly distribution, and we'd rather get a bonus or catch up in December when we know we've navigated some of these changes in the market well, than really freaking out or thinking like, okay, this is a bad sign. And then as a sponsor, working harder for the first dollar will keep the long-term relationship. And what I mean by that is, push away the temptation to raise capital by putting out pro formas that are super, super compelling. We usually create a good, a worst case scenario, a good scenario, a better scenario, and a best scenario. And we usually sell based on the good scenario, not even the better or the best, because even though it might be harder to earn someone's business initially, if we are continually outperforming or at minimum performing to those expectations, we will have a longer term relationship. And for the LPs, being able to count on the consistency, that's really something that a lot of LPs value. And candidly, we haven't always been able to do that. Again, lessons learned, mistakes learned is come in at a lower number and raise it when you have a lot of certainty of execution. Getting into humility, this is really about what you don't know. Even after doing this 20 years, people can think, oh, you know everything about the space. Well, we really don't. There is no way to predict everything. And every deal I work on, I learn at least one brand new thing. If you rate your success on a deal only by what hits the bank account, you could be deceived out of a mistakenly really prudent manager that's being very cautious and careful. And so again, going back and being humble enough to say, explain this to me, walk me through the P&L, walk me through the T12, show me how the project is doing, so that I can understand as a limited partner if my project's doing well or not. The flip side, I've seen sponsors push out distributions artificially, and then ultimately end up leading to a project that ends up bankrupting or getting taken back by the bank. So here, remembering that your lenders are the largest part of your capital stack as a sponsor, that's really important. Sit down with your lender, work with them, figure out what their vested interest is. That's been a really helpful thing for me as a sponsor. I ask my lenders, what markets do you want to be invested in? What's your sweet spot for making a loan? If I bring you a deal, what's a deal that it's a no-brainer for you? And a couple of things have happened from that. Number one, my lenders actually bring deals to me. So, somebody else goes out there, they underwrite a deal, they bring it to a lender, they don't buy it. Then the lender will call me and say, hey, we just underwrote this deal for so-and-so. I think you should take a look at it. We want to make the loan. We just didn't want to make a loan to him. And so then we get to call them back and say, yeah, we love it. We'll take it. So most of our deals are sourced by either our lender or a known seller that we work with. Again, I talked about before, taking a long-term perspective, be early and upfront with challenges, work together, create a safe space to communicate about what's going wrong, avoid, being accusatory or aggressive, and put long-term fixed debt wherever possible. Doing those things are going to make sure that your deals, whether you're investing as an LP or coming in as a sponsor, that your deals are going to be able to navigate any kind of market. So as a conclusion, right? Well, let's recap. We can still move boldly, even right now, even with all the unknowns in the market and even the major market swings, if we are being a good steward, right? If we don't want to rely on blind trust. Make sure that each of us understand what we're doing. Our roles and responsibilities are clearly articulated, and they are supported by good systems and processes. There are a lot of investors, a lot of resources out there to be able to teach you if you don't know, and also start small if you don't know. You can start with a small investment and learn as you go. I am a big fan of learning by doing. So I'm not saying don't do any investments until you understand everything, but start small, be prudent. I had one partner who inherited a lot of money and she wanted to invest it all at once. And the biggest thing I kept telling her is, go slow. It's okay to leave things in cash for a little bit while you figure it out, while you build the relationships. Remember, trust, track record, regrets, underwriting assumptions, strategy, and tough questions. Understand the philosophical underpinning and decision-making and rubric of your sponsor. Why do they do what they do? How do they do it? And don't just rely on Instagram posts of private jets, fancy cars to indicate someone's been successful. Having money isn't what makes someone wealthy. It's knowing how to keep it. Be prepared for tough periods and be prepared to either double down with a good sponsor or quit. It's not helpful to just place blame. Once you're in a marriage, a business marriage, you're committed. It's healthy to have open, honest, candid discussions, to be transparent about objectives and values and reassess things, but always do so from a perspective of creating a win-win and finding a solution. Working transparently as a team with your passive investor, your LP, and your syndicator allows for more successful projects. Avoid dealing with people who have unrealistic projections, such as adjustable rate mortgages that are never going to go up. Be able to predict and assume that there's going to be market corrections. So I hope that this webinar scared you a little bit. Investing does come with risk, and there are bad actors out there, and there are people with good intentions who don't know what they're doing. Many investors who are new to the space and will find that this is your first down market. You may have not developed the emotional fortitude it takes to ride out long-term value creation. But Warren Buffett did not. I want to encourage you, because Warren Buffett did not start making substantial money until he was in his 60s. Many of his investments were long-term buy and hold, and waiting for those to accumulate and compound is what really put him in a position in his 60s to be able to start to make big moves. Even Jeff Bezos was 55 years old before he made his first few millions. So, it does take time, and it takes consistency. Investing is ultimately an emotional game. The ability to control your emotions, surrender the outcome, and focus on your process directly correlates with your long-term success. Whatever you do, make sure you're moving in a programmatic and thoughtful way. Well thought out discipline and consistency. Exercise your values and remind yourself during those values in down times. What was the plan, and has anything changed fundamentally to make you change that plan? Most of the time when people walk away or lose an investment, it's because they don't have the emotional fortitude to continue investing in something that may look like a lost cause, but long-term has a good buy and hold perspective. A quick anecdote on that: my very first single family home I bought for $140,000 in Phoenix in 2004. Obviously, when the market went down in 2007 and 8, that home, the one across the street, was listed for sale for $45,000 plus or minus, and it had an extra bedroom and a pool. Many people in that market said the market will never recover. They got fearful and they just handed the keys back to the bank. They walked away thinking that 100,000 would never come back. 10 years later, not only has that 100,000 come back, that property is worth over $350,000. It has produced cash flow for me that entire time. And by not damaging my credit, I have been able to continue to buy aggressively. And in addition, I stuck with my strategy and I continued to buy more properties during the down market. So even though that specific asset didn't recover for 10 years, my overall portfolio was back to positive within a year and a half. So it's having a big picture, a comprehensive picture, and a long-term buy and hold that will help you navigate. And structurally, long-term debt and building things with foundational building blocks with strong systems and processes, that's what's going to get you through. And we're about to go into one of the greatest buying opportunities of our time, in my opinion. And just make sure that when you do that, you use these prudent strategies. They will set you off strong. And if you're already looking at some losses, just focus on the future, focus on sticking with those long-term strategies. You will recover more quickly from those losses. So questions. Any thoughts on problems with commercial real estate with the changes from hybrid and remote work? Do you see problems coming? So are we talking about commercial real estate like office space? So hybrid and remote work is definitely going to affect office space. That's an asset class I am very cautious on. I will say I just bought an office, but I own the company that's in the office. So in those situations, I think that's a little different. But other types of commercial real estate, WeWork spaces, industrial, commercial residential, I think those are going to continue to present wonderful opportunities for a long time to come. When it comes to commercial, like office type space, what I would do there is just look at the zoning and what other things could be done in that space. For example, and I haven't done this, this is just thinking off the cuff, but being creative. If, if I was looking at buying an office space in an office complex, I might want to see if both the office HOA rules and the zoning allow for me to make that an Amazon Prime delivery bunker, right? So if there's other offices that are there, maybe I could leverage my space a little differently and make it a place that people are going to be delivering Amazon product. I also think that people are still going to want to get out of the house once in a while. So office isn't going to go away forever. Working from home is hard. It's emotionally exhausting, and it's a great benefit periodically, but people still want to go to the office. Good presentation. Your experience shows. Never heard create a safe space in a business presentation before. Thank you. I appreciate the feedback and the accolades. Thank you very much. What markets do you focus on? So our firm has grown a lot, and so we work with a lot of other syndicators. We call ourselves a super syndicator. So our sub syndicators focus on a lot of different markets. I personally am focused still very much in the Midwest. I love that market, and we're starting to buy there again. We're working on a deal right now out in Athens, Ohio, that I'm super excited about. But we also have stuff in Puerto Rico. I went to Puerto Rico and I lived there, and I started investing there after 2013. I just thought that the US market was getting pretty inflated, and Puerto Rico had a lot of challenges that made it a pretty exciting market. So I've been investing in Puerto Rico and in Ohio and the Midwest for the last couple of years. I'm also very interested right now in being in debt positions where I can be in a low leveraged debt position. But more than anything, my focus is buying properties that have assumable low interest loans. So there's still debt out there that people are going to want to still sell a property, and I can still benefit from 3-4% interest rates by assuming loans. So that's driving it really more than the physical location. And I still think commercial residential is bread and butter. We have to be a little more thoughtful about collections. Some of the laws from COVID aren't going anywhere, and it's going to take longer to get unpaying tenants out. But I have some creative, we could do another webinar and I could go over some creative market incentives to get out non-paying tenants if people are interested in that, and also attracting better tenants. So that could be another webinar, but really the market for me, it's more about product. Some of my other sponsors are focused on hospitality, low cost, where it's like people who are paying by the week, renting hotels by the week. I have other sponsors that are focused exclusively on debt, and some sponsors that are just focused in the Dallas market. So it just depends. When we find a great operating partner or sponsor, if it fits our model and they align with our high level strategic values and principles, then we work with them. I missed the start of the presentation. Do you see a downturn coming that could create the greatest opportunities you see ahead? So it's interesting. We have so many variables happening, and I do think that after the last great recession, we will never see the same kind of what I would call global recession we had in that market. Going forward, sub-markets are key. Knowing individual sub-markets is going to be where we separate the women from the girls or the men from the boys. Overall, we can't say things like the real estate market's going to crash, interest rates are going to go up. It's going to be much more specific than that. It's going to be negotiating in your debt, whether you're tied to the 5-year treasury, 10-year treasury, or LIBOR. Do you want to be tied to an international rate or a domestic rate? When you are doing looking at acquisitions, you have to look very specifically at market trends. We're seeing big changes in where people are moving to. So some markets, in my opinion, like California, are going to get hit really, really hard. But I think the Midwest, I think Florida, I think Idaho, these markets are going to continue to do quite well. So it really is sub-market specific in a way that it never has been before. And I don't think that's going to change. And that's part of why we moved to this super syndicator model. I don't think it's possible for any one person, myself included, to know a sub-market well enough to really make an excellent decision in that market. And so working with people who have very localized knowledge is going to be critical to my strategy going forward in the next 10 years.
All right. Well, thank you very much, everybody, for joining us. Kira, this is amazing, really invaluable information. Thank you so much for sharing with us today. We hope to have you soon again in the future. And I hope everybody has a great weekend.
Absolutely. Thank you, guys. Yeah, I plan to be there in August at your event. So look forward to that.
Amazing. We'll see you in Dallas then.
Yes.
Don't miss it. Thank you, everybody.